This morning, futures are a little bit flattish at the moment. Interest rates are up a bit this morning. Stock futures are flat. Dow's up because of energy and what's happening with the material side because of what's happening in Israel, of course. But kind of the rest of the market a little bit flat today. Here's what you need to know before the bell this morning. Markets did come down on Thursday and Friday. So we had this very big rally that ran for about a week. Came off the 200-day moving average, ran right in, and we talked about this last week, ran right into the 50 and the 100-day moving average, where those two moving averages are now crossing each other. So a lot of overhead resistance here, and we said that likely, we could see a bit of a failure there. See the markets pull back a bit. That's exactly kind of what happened. Came down, sitting right on the 20-day moving average. Now this morning, futures are a little bit flattish at the moment. Interest rates are up a bit this morning. Stock futures are flat. Dow's up because of energy and what's happening with the material side because of what's happening in Israel, of course. But kind of the rest of the market a little bit flat today. So again, we'll see how the markets open. Kind of need to hold this 20-day now. It's entirely possible that we could come back down and retest the 200-day moving average again. That's certainly not not outside the realm of possibility at all. Particularly given that we did get kind of a lot of that oversold condition, had reversed a lot of that oversold condition with that rally. So again, a bit of a pullback here, not surprising, not terrifying, anything else, but that'll potentially set the markets up again for another rally as we get into November and December. And again, we had written an article a couple of weeks ago talking about October weakness, and that it's certainly not surprising if you see a little bit of weakness in the month of October, particularly coming out of August and September. But as we get further into earnings season, if earnings kind of come in and are supportive, but then once we get into November and December, we have stock buybacks reopening. So again, that's kind of the support for that year-end rally. Again, none of that's actually changed here at all. Markets are kind of doing what they're doing at the moment. There is a bit of a downtrend channel. We do want to pay attention to that. If we do take out the 200-day moving average, then the whole dynamic changes here, at least in the short term. So again, this is a real kind of important range that we're trading in at the moment. Want to keep a watch on this for sure. Again, nothing going on here to be overly concerned about. MACD buy signal is in place here. That's what kind of gave the lift to the markets over the last couple of weeks. And again, positioning is very negative. Again, a lot of fear and loathing in the markets. That's really kind of that setup here. We've got a lot of positioning that is offsides at the moment as we go into year end. A lot of CTAs, a lot of professional managers behind in performance this year. They're underweight equities right now. They've got to get that money allocated on the books. So that's why you typically have this kind of year-end push, and mostly it's just positioning to get into year-end reporting. So again, there's certainly a lot of things, and again, there's while historical precedent leads to year-end rallies, it doesn't mean it has to happen. There are years that you don't have year-end rallies. A good example of that was 2018. The Fed was hiking rates, nowhere near neutral rates. Market sold off in November and December. You're down 20% over 2 months. So there are certainly periods in history where year-end rallies don't occur. They just occur more often than they don't. So if you're playing probabilities and possibilities, the probability is you're going to have a rally here. So you kind of want to be somewhat prepared for that, but you've also got to be a little bit aware that there's certainly risk in this market, particularly with everything that's going on a geopolitical basis, as well as just really a financial, economic basis. The lag effect of all these rate hikes still sitting in the markets. We're well within the ranges of the lag effect period of whether it's inverted yield curves or whatever it is. There's normally a 12 to 18 to 24 month lag between the time that those invert and the time of the onset of recession. So we're still well within the period where these lag effects occur. But so those lag effects are still sitting out there. That's still going to weigh on economic growth. The Federal Reserve, of course, also coming up at the end of the month. Will they hike rates? Won't they hike rates? Odds are right now that they're going to hold rates pat. And they've really kind of been dropping those hints over the last week with a lot of Fed speakers. Another one out today, kind of saying, the recent rise in 10-year Treasury yields have done the work for them, so they don't need to hike rates anymore right now. So again, there's lots of moving pieces here to pay attention to. But again, we've got to pay a little bit of attention, give a little bit of homage to seasonal probabilities, and kind of give a little bit of specific for that, particularly given the buy signal in place. Short-term overbought is going to work itself off here over the next few days. then kind of get set up here for another bit of a rally. So we'll see how the market kind of plays out today, and then we'll keep you up to date as we kind of go along. That's what you need to know before the bell this morning.